The topic of this video is how to use option expiration dates to dramatically improve your rate of success and return on investment in your trades. And that will also chain into how to become more confident in your trades so that you're not doing things like hesitating when you should be executing, exiting a trade when there's money to be left, or falling prey to bad advice. In particular, we're going to focus on how to leverage the DTE, that's days to expiry, filter within the unusual whales option flow. Now, for reference sakes, I'm displaying just a few of the callouts I've made recently along with the results to underscore the importance of this video, because in each and every single one of those scenarios, I leverage what I'm about to explain to you here. Now, if you want to see more, my entire track record is completely transparent for you to see on Twitter at PROFITSTAKEN. I call out trades well in advance. I don't play the numbers game of calling out a big list of trades hoping one hits. My list is narrow because I have high conviction in each and every one. I also don't play the numbers game of calling out both calls and puts, since that's not conviction. That's like saying your insight tells you that a stock may go up or may go down, then celebrating when it hits either. That's a numbers scam where the person can never really be wrong, and it's probably the most common and easiest for you to fall to as well. Now, I'm telling you this now not only to help you avoid scams, but also because we're going to use filters and analysis to find high conviction trades, high confidence moves where you understand why you're taking it. So let's get right into that, as well as some very important items that you need to know as we discuss expiration filtering. Now, first of all, I want to open by saying that I'm a former professional, licensed stock trader and options specialist. As noted, I search for high conviction trades, and everything I do and explain in these videos is designed to help you understand how to do the same or to execute on your ideas. Now, secondly, I'm going to stress the word understand, as I do in most of my videos, because I want people to understand what they're doing and why they're taking a trade, as opposed to memorizing a process. Fake gurus and con artists are great at memorizing things to give off the appearance of understanding. The reality is, if you don't understand what you're doing, then you're going to bounce from one trading method to another. Not only that, you'll trade chaotically. Why? Because you don't know why it isn't working, and you're shocked and you don't understand what's going on. So you don't react properly. You hold and you lose big. Or in the best case scenario, you just aren't able to execute on trades because you know that you're missing something and it just doesn't feel right. Or you get some winners and eventually take some losers, or you get some winners and you get some losers, maybe end up a little bit ahead or a little bit behind, but you end up believing that you're the problem, everybody else is killing it, and maybe trading just isn't for you. Now, if some of those cases sound like you, I'll expand later in the video, so be sure to listen all the way through. But for now, let's break down the days to expiration within unusual whales. Now, one of the top questions that I get is, what number should I set that to? What number should it be? Well, again, if you've seen my options premium video, if you haven't, there's a link, you'll see it in the top of the screen. Cue that up, make sure you watch it. There's no single specific magic bullet number, just like there isn't with options premiums. It doesn't work that way. And I'll caution you again that anybody giving you some sort of cheat sheet with a magic number, red flag. They don't know what they're talking about. They're trying to oversimplify because it's a great way to get followers and grow your account, oversimplifying things and creating easy rules. Unfortunately, that might grow someone's social media account or get a few views because people like things broken down in a simple way, but it's not going to grow your bank account. It'll just grow someone's social media presence. And it actually doesn't make any sense in the real world. So let's examine why. Now, days to expiry has a close and tight correlation to theta. What is theta? Well, if you're not familiar with theta or the Greeks within options trading, you might benefit from an options crash course, which I'll look to put together at some point in the future if time permits. For the moment, and as it pertains to expiration dates, theta is the rate of decay, and that means it measures the speed at which your options contract is losing value day over day. Now, why is that important to pair with expiration dates? Because the sooner your expiration date is, the greater your rate of decay is going to be, all else equal. So let's analyze a real world example right here so that you completely understand, because I don't want you to just remember what I'm noting. As I said earlier, I want you to understand it. That way you can apply it to your own trading. You don't need to be going to anybody else for their advice. Now, what you see in front of you are Facebook call contracts with a strike price of $337.50 and an expiration of December 17th. As you see, I created a little box top left, December 17th. Now the theta is minus $1.52. That means the premium, aka the extrinsic value of these contracts, will drop approximately $1.52 by tomorrow. $1.52 per contract means $152. This is independent of anything else, meaning that if the price of the Facebook stock were to remain exactly where it is, the option contract would drop by this amount come tomorrow. As you can see, that constitutes over 50% of the value of our options contract, which at the time of this recording was selling for between $259 and $267. It's pretty devastating to think of, right? The price doesn't even have to move against you, and you could lose over 50% of your contract value. Okay, now keep that in mind, that rate of $1 minus $1.52 per day. Keep that in mind. Now here's another screenshot. Same strike price, but the only difference is the expiration date for the contract. Remember, we're talking about expiration dates, days to expiration. Now look at the theta now. It's only minus 48 cents, which represents just over 7.5% of the current approximate value of this contract. As I said, look for my options crash course, which I'll work on once I get an opportunity, if you don't understand things like theta, delta, and IV perfectly. Because basic understanding of things leads to losses, and you're better off knowing nothing and not trading than you are just knowing a little bit, taking a trade on false confidence, and then getting crushed. I'll announce it here and on Twitter when it's ready, as I'm doing it in my spare time. But let's get back to it. Now, assuming this makes sense so far, we realize that there's a big difference between those theta values. Now, why is that important to us? Because it tells us how much risk the options buyer or seller is taking on these positions. For example, you see a huge multi-million-dollar move on Facebook today for a strike price of $337.50, where the expiration's tomorrow. You know that this buyer or whale has very high conviction, all else equal, meaning they're very confident things are going to go their way and that they're willing to risk a potentially substantial loss if the price doesn't move in the direction they're hedging on. Now, again, this is all relative, since understanding the exact level of exposure requires deeper analysis into things like their premium exposure, but for all intents and purposes here, an expiration tomorrow versus a week from now represents a much higher threat to the holder of these option contracts. Again, we saw how the week out is only losing about 7.5% of its value each day, whereas tomorrow is losing over 50%. Okay, now, so what does that all mean when filtering on unusual whales? Well, similar to the premiums filter, see my video on understanding options premiums, it means you need to understand the context of each data point. That means there's no magical number of 20 days, 40 days, 50 days, or 70 days. Now you understand why I say that anyone giving you a hard number is exposing themselves for not knowing what they're talking about. Think of it as a weighted scale. The further out your contracts are, the lower the theta will be in general. The closer they are to expiry, the higher the theta. Said differently, the closer you are to an expiration date, the greater level of confidence and conviction your move is, because you're risking much more if things don't go your way. Again, all else equal. Now, does that mean we should only be looking for weekly expirations? That we should only scan weekly if we're making day trades? No, absolutely not. Thinking that way is understandable, but it's the same type of oversimplification that a fake guru would explain, or someone that would say only 40 days, or whatever the case. There are a lot of reasons why a highly convicted move is not always going to be made in the same week. First of all, there may not be liquidity, meaning that someone can't make a big enough move since there aren't enough contracts available to buy, so they move out to a different date. The buyer could also be using options as a hedge instrument for a variety of different reasons, or they may simply get better value at a later date if they identify tighter spreads. Whales and institutions dealing in large amounts are examining every facet of the move and trying to maximize their profits. Many traders look at weekly expirations simply because the barrier of entry is lower. Remember how tomorrow's contracts were about $2.60, but next week's were over $6.25? That means buying one of this week's contracts would cost $260 each, and next week would be $625 each. All else equal, your average trader wouldn't be willing to spend $625 instead of $260 per contract if it meant that they receive better spreads that puts them ahead, say 2% to start the trade. That's because most people have limited resources and are focused on a short move in their favor. Whales and institutions don't have the same constraints. They're spending a lot more, and that 2% that they can save on a spread by going further out is worth far more to them than it is the average person given their scale. As a result, they're willing to extend out to different dates in the future in order to get better value. And those are just some of the reasons, but suffice to say, no, you shouldn't just be looking for the end of the week. They could be taking contracts that are further out even though the move is coming tomorrow. So where should you set your filters to? Now I want to stress that you need to examine the theta as well as other underlying points that I'll break down in future videos. Also check in on my options premium video. However, a very general concept is to examine approximately 180 days out to begin with, that's 6 months, then start narrowing your search. So don't just go with one, start narrowing it. 180 days is going to yield a lot of information. The further out the date, the less relative, I stress relative, weight I apply to it since it comes with lower exposure to the contract holder. And then once you have it at 180 days, you can incrementally move your time slots down closer and closer, almost like taking a zoomed out view and then zooming in, zooming in, zooming in. And each time you zoom in, we're going higher exposure, higher exposure. Now, this will also hinge on what type of trade you're trying to make. So keep that in mind. That's why it's not a one size fits all. If you're making a long-term trade, looking to purchase a leap or buying the underlying for a longer swing trade, you can push your dates out further. If you're looking at a closer move, you narrow. For example, if I'm scalping, I need to reduce the noise, so I'll tighten up to starting at 60 days. See my scalping videos for an overview of how I scalp. And if you want to see a perfect example of expiration dates coming into play just as we discussed, view this video on how we identified a Spotify move where heavy volume came in at the end of the day, just minutes away from the end of the day. We were heading into expiry and resulted in a big move. Now, this is important. So let's recap to clarify things. The closer to expiry, the more risk there is to the buyer, and this suggests a higher relative conviction level. Said differently, it suggests a higher level of confidence from the option holder. The option holder that we're following, specifically with unusual whales, are institutions in whales. So if an institution in whale has high confidence, that's a good lead for us. The further out, the less urgent it is that the stock makes a move in their direction. So that's something to keep in mind. And this is important to know, so you add this to your other elements of analysis, with the idea being that when you combine all of the different pieces here that I detail, and any that you properly understand, you'll begin to see which moves are relevant and indicate a higher level of conviction, aka someone who knows or strongly believes a move is coming. Conviction. So I hope you've enjoyed this video. If you're ready to start using unusual whales, please see the description in this video and you'll have a link to get a discount, or use the code PROFITSTAKEN. And if you're already using unusual whales, you can still set the code in right here, putting it up on the screen. Just enter PROFITSTAKEN. As always, I highly recommend hitting the subscribe button right now and turning on alerts so you can get all of my future videos, which will break down the things that you need to know. I also strongly recommend watching my other videos for greater context because these elements all work together. Real trading isn't about a few easy, rigid rules and a quick tutorial. It's about combining things together for a deeper understanding so you can know how to trade and do so with confidence and consistent success. Finally, please stay posted on Twitter by following me at ProfitsTaken. See you guys next time.